Many fear that bonds cannot add value to the portfolio if interest rates keep rising, with central banks hiking interest moderately across the globe. The big question that's looming on everybody's head is whether you should make bonds part of your portfolio or not, since both of them have inverse relationship. Let's find bust all the myths when it comes to investing in bonds. Where will yield head, and should you make yields part of your portfolio or not? To discuss all of this, we have on board Lakshmi Iyer, President and Chief Investment Officer and Head Products, Kotak Mahindra AMC. Lakshmi, good evening. Welcome to the show. How can one make money out of bond yields in the current scenario?
Hi, Kavita. When you are talking about investments in financial asset class, you are talking about largely equity and fixed income. And fixed income to that extent is underrated, because it's not that fancy looking in terms of returns. But if planned well, depending on the nature of the risk appetite you have, and most importantly, the kind of longevity you have, you really can plan for investments as low as say 30 days. You can plan investment of 300 days, and of course, you can plan investments for as high as 3,000 days. So I think that's the beauty of what fixed income is all about. And specifically in today's kind of a market scenario, where from where you were 6, 8, 12 months back, interest rates have actually gone up. So I think it's important that viewers take this into consideration and make allocations into fixed income, not to grow their money, but most importantly, to have a more stability orientation on their financial portfolio.
And is now the right time? Do you think the interest rate hike by the RBI and the central government has already been factored into a larger extent when you talk about bond yields? Should one really wait to look at more price hikes, or today is the time and you should just go ahead if you've decided?
So clearly, what you said first part is absolutely right. Bulk of the rate hikes, which have already happened, of course, that's in the price. What is likely to happen also, to a large extent, is already there in the bond yields or the bond price. So what are you waiting for? There will be volatility. I think viewers and investors should keep this in mind, that in every investment, whether it's equity, fixed income, gold, real estate, there will be volatility. But the beauty to ride out this volatility is to invest in installments. And you can do that even for fixed income, because we have obviously way away from where interest rates bottomed out, but have we already peaked out in terms of interest rates? The answer is probably no. So when you are in that little sweet twilight zone, it's okay to stagger your investments over the next 3 to 6 months to be able to enjoy the benefit of that elevated yield onto your portfolio.
Scenario, Lakshmi, what kind of bond-related financial instruments are we talking about?
Well, the entire damage is available for you. There are bonds which are issued by the government of India. There are bonds issued by state governments. And there are, of course, corporate bonds which are issued by public sector and private sector entities in India. At the current juncture, looking at where each of these are priced, given the absolute yield levels and the relative yield levels, we believe that there is a great opportunity for investors to look at sovereign bonds, both center and state. Because it's not that it's not a great opportunity to participate in corporate bonds, but the gap or the yield differential, which is what we call the spread between the government bonds and corporate bonds have almost collapsed. There's hardly any gap. So therefore, on a risk reward base, we believe that a sovereign investment today is a far better and superior opportunity in the works. And in terms of tenor or duration, we like anywhere in the 3 to 6 year kind of a bucket. So if you want to buy 2025, 26, or you want to buy 2028, 29, or you want to buy funds which have durations around this, go for it.
What kind of an interest are we looking at from these bonds for this tenure?
Currently, if you look at funds which are, say, high grade portfolios, which have duration of around 2 to 3 years, which means average maturity of close to 4 years, the portfolio yields, from a mutual fund perspective, and that's pretty much reflective of the market, is close to 6.9 to 7%, around that range. And then, of course, there are vagaries of interest rates which can play to your advantage and reverse. But that's the kind of prevailing yield available. And the 10-year benchmark government bond in India right now is currently at about 7.15.
Do you think it would be a good option for senior citizen right now to look at these bonds investment?
Well, senior citizens do require, probably some regular cash flows. So they can also look at this category. But even senior citizens with a small or sparing risk appetite, what we usually also tell them is to also look at debt hybrid funds. Now, these debt hybrid funds are predominantly fixed income, but they have a small tail end equity component, and that's what they call debt hybrid. So you can look at, yes, you can look at long-term bonds, which are 5 year, 7 year, 10 year in nature. And you can also look at a combination of these debt hybrid funds to probably, augment a little bit of potential return over a period of 3 to 5 years.
I have to talk to you about a lot of things around inflation, especially global inflation. But then before I go out there on that way, can you explain us dynamic bond funds and how do they work and how in this current scenario one can really place it very well in their portfolio?
Dynamic bond funds are all about active, active, active. So the word dynamic is quite synonymous. So if you have a view that the markets are going to be volatile, it's going to be very difficult for you to get the precise timing, which is true for most of the times. Dynamic or actively managed funds, as they are called, seem to be the place where you can actually put in your monies and keep this for a period of 2 years, 3 years, 4 years, 5 years. Here, what happens is the fund manager or the portfolio manager, depending on his or her view on interest rate, actually moderates or modulates the duration of the portfolio. Which means if the view is that, okay, things are looking fine, you actually buy more bonds with longer maturity and you enhance the duration of the portfolio. And reverse, when you believe that, oh, world is almost going to come to an end, interest rates are going to head northward, so you actually reduce the duration of the portfolio. By doing so, you're actually increasing or decreasing the interest rate risk for your investor. Some of them choose to do that with credits also, but by and large, I'm giving you the majority of them, by and large, it is done for duration or interest rate risk management. So definitely look at actively managed funds. And in our experience, Kavita, we have seen, and of course there is data to show that typically over cycles, actively managed bond funds or dynamic bond funds have the potential to outperform passive or the benchmark that's available.
Now, okay, when we talk about global triggers that are impacting our equity markets, obviously there's a lot of volatility. But what kind of global triggers also impact your debt part of the portfolio or the debt market? Can you just explain that?
Every global trigger that impacts a financial market, it has to impact fixed income. So to start with, if there is a massive outbreak of inflation, which is what we are seeing right now in the Western world, the tendency that those central bankers, whether it is the US, whether it is the ECB, will hike interest rates faster. Now that acts as a very strong headwind for domestic bond yields also. So that's number one. Number two is commodity prices, specifically crude oil and to some extent gold, because these are our two prime import commodities. Now, as these prices go up, usually gold, when prices go up, you don't consume more. But for crude oil, we are agnostic of the price. So we actually keep buying more when it's low, high, whatever. So these commodity price trends globally, because we are price takers and not price makers, are also equally important. And of course, lastly, the geopolitics. Whatever is happening in the globe, if there is disruption on any of these, whether it's commodities or any supply chain, I think all of these blended together actually give some sort of direction or anchor over and above the domestic factors. Of course, I must hasten to add that sometimes domestic factors have a predominant bearing compared to offshore and vice versa. So degrees might vary, but certainly they do impact bond yields as well.
Let's talk about few myths that we should bust on when it comes to investing in bonds. A lot of people think that fixed income usually do not offer growth opportunities. How true is that?
So as I said earlier, if you are looking at growth, then you have to try to get the cycles of interest rate in terms of timing right, which means you're trying to enter at the peak of the rate cycle and then try to ride it through when interest rates are easing. Then there is a potential opportunity. On a consistent basis, if you are talking about compounding effect on your monies, it's asking a bit too much to for fixed income to be able to generate that, given that we already have you know uh, a 5 to 6% kind of a steady state inflation in our system, and to that extent the tendency to pull down rates beyond a particular threshold will be very, very limited. So yes, for some bit of stability of your returns profile on your fixed income, on your financial portfolio, fixed income, and I colloquially actually call it the new money of your portfolio. It doesn't have caffeine, so it doesn't have the energy boosters to be able to multiply wealth at a pace which equity can potentially do.
And what about liquidity? Fixed income is always less liquid than the equities. Is that true?
See, secondary market liquidity for government bonds, absolutely fine, no worries at all. Corporate bonds, relative to government bonds, certainly the liquidity is relatively low, which is why we tell investors that participate through open-ended mutual funds. The portfolio managers doing just that, managing your interest rate risk, managing your liquidity risk, because you have daily payout funds. It's a daily entry exit funds, open-ended funds, and then of course trying to manage the credit risk. So it's a troika of risk which you have to manage and keep in mind among other risks when you are investing in fixed income. So keep that in mind when you are using your vehicle to participate into fixed income. Mutual fund is one such vehicle.
And this is all a part of your risk appetite if at all you are investing in a fixed instrument. What about age? Because in equity, usually the thumb rule says that the higher the age, the lower the exposure in equity. Is it reversed when you invest in fixed income?
So, if I'm an entrepreneur who has sold my business at a very, very young age and made tons of money, and so much of money that I don't have any wish or will to really grow it even more, and I'm doing some other tertiary business, then my only objective is to preserve that wealth. So, despite the fact that you are very young and whatever age that you are, your primary objective is preservation of the wealth that you have created at such a young age. For that kind of an investor, fixed income plays a predominant role. If you are an investor who has already retired, is well above seniors, but I don't want my day-to-day expenditure to come in the way of my wealth creation. So, well, age is one of the criteria, it's a necessary condition. It is not a sufficient condition to determine how much of money should actually go into fixed income.
In the end, a higher reward needs higher risk even in a fixed investment.
Definitely, the more you sweeten your rasgulla, the tastier it gets. So yes, if you take a higher degree of credit risk, the potential to earn that additional return is definitely higher. But bear in mind that the faster you zoom past 100, 120, 130 miles or kilometers an hour, the chances of an accident, in this case, I'm talking about credit default, is equally higher. So, yes, with higher risk comes the potential for higher return, and equally high are the risk hazards. So, keep that in mind and weigh your balances. Likewise, in the duration, the higher you go, the chances of making money in a favorable interest rate scenario is reasonably higher. But keep in mind, जोर का झटका जोर से ही लगता है.
Let's talk about the global scenario. What's actually concerning for you when you talk about UK and the entire Eurozone right now?
See, right now, as I said, the biggest worry is how much higher can these policy makers take their interest rates. Very, very important, because inflation is going ballistic, whether it's in the US, whether it's in the ECB. Most of these economies are likely to hike their interest rates by 0.5% to 0.75 basis, 75 basis in the upcoming policy. That's not really true for India. But India cannot be unimpacted, given the fact that it is part of the EM, or the emerging market piece. And when a developed economy does something like that, especially the US, their currency starts getting stronger. So I think there are a myriad of these factors which we cannot ignore. We will act obviously basis our ailment, which is significantly lower. We may be probably suffering a viral fever, where some of the Western world is actually having a dengue fever. So the medication obviously is going to be different. But we need to be mindful that even a viral fever needs some treatment.
We will have CPI data coming in now in a few days. What kind of a direction do you expect we will get?
See, this time inflation might show a slight uptick, but as I said, it's not going to be materially, trajectory-wise, distort the trend or the forecast which RBI has put forward. So it seems like, on balance, the trajectory for CPI in India seems to be heading on the lower side. Also, as we speak, crude oil seems to be fizzling out. While one doesn't know how long can that continue, but all of that are good fodder and inputs for a slightly more, futuristic, benign inflation. So for now, the FY 2023 Q4 forecast seems to be well within the 6% region, which is placed at 5.8. At this juncture, I think we are on track. Maybe the next data point, as I said, which is going to come in a few days' time, maybe slightly inching higher, but I don't think that's going to be a material showstopper.
All in all, talking about India and the rate hike perspective, or the entire scenario, all in all, what is the rate hike that you're looking at?
We are at 5.4% on the benchmark repo rate right now. To our mind, looking at the Q4 inflation forecast of 5.8, and assuming we want to be in a positive real rate territory, maybe there could be another 0.5%, which will take the repo rate to 5.9, or maybe a zero point 0.6, which will take it to about 6% between now and, say, Feb end. That's when the last policy is for this financial year, which means that we are well within the inflation threshold, and of course, our objective of being positive real rates. After that, of course, is inflation, which will be a key driver domestically, and of course, how much of speed breaker the rest of the world, aka the US in this case, will take after being on fourth gear as far as rate hike is concerned. So I think that is important. So we think 5.9 to 6% could it be in two tranches, in one tranche? I do not know that right now, but that's where we think interest rates could be by end of FY 2023.
All right, so less real worries for India, and so good time for you to diversify into fixed instruments. Thank you so much, Lakshmi, for being on this show and guiding our viewers on how to invest in bonds and diversify their portfolio.